United Health Group just double beat their Q3 earnings and the stock was up 4% pre-market. Let's dive into what happened and what was reported, as well as what the management actually said. Welcome back to the Value Investor Show. Today I will cover United Health, the Q3 expectations, my thoughts going in, the results, the earnings call, my takeaways from both, and the intrinsic value of the company, as well as whether I'm buying or I'm selling the stock. As you guys know, I've been buying Duckers over the last few weeks and I have covered this on the channel, but United Health is another position that I have been adding heavily to back in July and August and posting about it consistently. Since then, I'm up 30% on my purchases. And as I have said before, I will reveal my full portfolio at 10,000 subscribers. So if you're new here, it would mean a lot if you subscribe. These videos take a lot of time and effort and I really appreciate the support. As you guys know, I've actually called United Health at $218, $250, $230. United Health was always a buy in the past. I've tweeted about it, I've posted about it on YouTube, and since then the stock has gradually or sharply gained back quite a lot of momentum. Now, United Health was up 4% on the back of its Q3 earnings call, but has since lost all that gain after the market opened and is now trading back to $360. Going into today's call, the expectations were off a cliff. Ever since the new leadership took over and basically reset guidance, they came in, set extremely low expectations and decided to take the hit early rather than fail to meet guidance later. For example, EPS is expected to be down 70+% from last year. As you can see from the chart here, there was a consistent growth of EPS in the past, but over the last 2-3 quarters there have been a huge decline as guided by management and reflected by analysts. Now, United Health has been a public company for almost 42 years and 78% of those years have been positive. That's 33 out of 42 years of positive performance. But this year, the company is on track to be on one of the worst, with the stock down 20 to 30%, which really shows how consistent the company has been historically and how exceptional its long-term returns have been for shareholders. Now, when it comes to investor sentiment, United Health was actually the #1 stock bought by top investors in Q2 of 2025 by a wide margin. And as 13F filings start rolling in over the next 2-3 weeks, I think we could see it in the top list once again. In fact, in 2.5 weeks, Berkshire Hathaway reports their 13F filings. And my question is, could Warren Buffett, the GOAT of value investing, have added more United Health between July and August when the stock dropped to the $230 range? If yes, we'll know soon because the 13F filings will show Buffett's investment activity during that period. It's expected to be released on November 14th, and I think that this could be one of the biggest catalysts for the stock. If Warren Buffett has added more, it could create huge upward pressure. If not, or worse, if he sold his position after the Q2 earnings call in July, that would be very bad news for the company in the short term. Another important catalyst for the future is the value-based care market evolution. United Health is heavily focused on expanding in this area. They mentioned this again during the earnings call, but value-based care is a market that is growing 17.4% CAGR through to 2032, and studies have shown that it reduces hospital entries by 50%. It's essentially preventative care and it's bending the cost curve in a sustainable way. This is huge because it both improves margins and reduces risks for insurers. And this is exactly where United Health is investing to reduce exposure to their less profitable segments and drive long-term margin expansion. Now let's get into the numbers. United Health double beat their Q3 earnings and raised guidance for 2025, while the CEO has also said they're eyeing growth in 2026. So overall, they ticked all the boxes. They beat EPS by 4%, they slightly beat revenue, and even though EPS is down year on year and quarter over quarter, the worst is very much behind this. I think Q4 will probably be the bottom and 2026 will be a comeback year for the company. United Health raised their 2025 earnings outlook to reflect net earnings of at least 14.9 per share and adjusted net earnings of at least $16.25 a share. This shows that management is cautious, but they're executing. They gave very low expectations, but they're beating those expectations. And now they're raising guidance. That's the key takeaway of today's call. The numbers themselves aren't explosive, but they're solid. Revenue grew 12% year on year. Revenue from operations were 4.3 billion with a very low net margin. Medical care ratio was 89.9, which again was quite high, but it was in line with the expectations outlined in the second quarter of 2025. Optum revenues also grew 8%, driven by growth in Optum RX, and the debt to capital ratio has remained unchanged in the second quarter. Now, the third quarter for United Health Group was higher by 12.3 billion, which took it to 113 billion this year. The third quarter consolidated medical care ratio of 89.9 reflected utilization in line with expectations. The year-over-year increase of 470 basis points was primarily driven by the previously described significantly elevated cost trends, as well as the ongoing effects of the Biden-era Medicare funding reductions and changes to the Part D program by the Inflation Reduction Act. So despite this revenue growth, which was exceptional, adding billions in new business, net premiums and other revenues also increased very strongly. Margins are still compressed, but at least revenues are accelerating, and United Health is buying back shares. Also, they have 30 billion in cash, so the balance sheet overall remains very strong. One of the areas I didn't like were Optum Health's margin. I expected some compression, but not to this extent. Net margins for United Health Group dropped from 6% to 2.1%. But for Optum, operating margins went from 7% last year to 3.6%. Optum has historically been the healthier part of the business in margins, which it still is, but the impact has been very big. This is due to the continued reimbursement pressure due to the Medicare funding reductions and elevated utilization and costs, which are affecting Optum Health. In terms of Optum Insights, the margins again decreased because of investments to support future growth and the contract revenue backlog being 32 points. And for Optum RX, the margins as well decreased because of a mix of effects of higher cost tracks driving higher revenue growth in the third quarter, but with lower margins. So overall, there are multiple headwinds that are compressing margins across all segments of Optum Health. Now, after listening to the earnings call, there were three main focus areas management emphasized. The first one is earnings growth. They're confident in returning to double-digit growth from 2027 onwards, driven by investments and efficiency actions already underway. They said the long-term outlook will continue to refresh dynamically as they execute and they adjust. The second one was around productivity. They're using AI and machine learning capabilities to enhance performance and improve productivity and margins. And thirdly is around value-based care. They're doubling down on product networks, disciplined risk arrangements, and they're trying to improve their performance overall to create better value-based care for their customers. In terms of my thoughts, there is a clear focus on cost cutting and operational discipline, both short and long term. They're laying the groundwork now for margin recovery from 2026 and beyond across all business lines. There was a lot of stuff that was talked about, a lot of moving parts, but the vision is clear, execution matters, and it will drive better results. They want to reevaluate the whole business, and a few themes that are now emerging are the reduction in international exposure and the focus on the US market. But generally, the CEO and management came across grounded, disciplined, and focused on their next goal. In terms of valuation, as it stands, the EPS guidance for management is that for 2026, the EPS will return to roughly 10% growth, and then from 2027 onwards, there will be a long-term EPS growth of 13 to 16%. So with those numbers in line, let's look at the bear, the base, and the bull case scenarios. So for my base case, I'm assuming the lower end of that guidance. I'm assuming 8% revenue growth and 13% net income and free cash flow growth. And under those assumptions, we are basically seeing that net income will surpass 2023 levels just in 2030. And with those assumptions, there is a margin of safety of 2 to 30% at this price point. So even at $370, the company is still undervalued. Not to the same margin of safety as it was 2-3 months ago to get me near my target of margin of safety of 50%. But even at this price point, the company is undervalued. Now for the bear case, I'm assuming a lot less. I'm assuming 5% revenue growth and 6% net income growth. So under those assumptions, net income will not actually recover to 2023 levels, and profit margins will remain at 3% as headwinds become tailwinds. And under those assumptions, the current price gives no margin of safety whatsoever. So the return would actually be negative in the long term. I do think that the bear case is far-fetched. I don't think this will happen, but it's still good to understand what the upside and what the risk is for the business. Now for the bull case scenario, which is very much a very possible scenario, is I'm assuming 9% revenue growth and net income and free cash flow growth of 18%. Again, I do think that there is a possibility that the management will beat their own guidance. So I'm putting 18% with just over their guidance of up to 16% EPS growth. And under those assumptions, I'm basically saying that net income will surpass the 2023 levels in 2029, and profit margins under this scenario will also increase sharply to 4.5%. And under those assumptions, I see a margin of safety of 21 to 44% with the DCF and EPS method. So a bull case scenario could have significant upside for this business. And with that said, am I buying or am I selling? Well, I believe that United Health getting back to 200s is very unlikely unless Warren Buffett has sold his whole position in Q3, which again I think is very unlikely. On the other hand, if Warren Buffett has bought more United Health, we might see a stock closer to $450, which would be massive. I'm not looking to add more, but with a cost basis of $280, I'm really happy with my position. I hope you enjoyed this video, and I'll see you guys in the next one.